All right, good afternoon, everyone, and I want to thank you for joining us today for this Postmedia pension merger webinar, specifically for defined contribution, or DC, plan members. Now, my name is Steve Hyland, and I will be the moderator for today's session. Now, before we get going, I would like to pass it over and introduce to you Adam Carpenter from Postmedia, who would like to say a few words. Go ahead, Adam.
Hi, everyone. Welcome to today's information session on the proposed merger of Postmedia's defined benefit pension plans with the CAAT pension plan. As Steve said, today's session is for members of the Postmedia defined contribution plan. And I just want to start by clarifying that those benefits that you've accrued in that plan are not part of the merger. But if the merger is approved by the Postmedia defined benefit plan members, all of our defined benefit and defined contribution members will begin participating in the CAAT pension plan. This will allow Postmedia to provide and expand defined benefit pension coverage for all of our employees. And to give you even more history, over the last few years, Postmedia had been looking for different options to provide a sustainable pension benefit, and we believe the proposed merger with a large jointly sponsored plan like CAAT will provide our active and retired members with a secure and stable retirement benefit, as well as providing, predictable funding for the company. So we're currently working on the member consent process related to the merger, and if approved on July 1, your benefits are going to change. So take this time today to learn about the CAAT pension plan and get any questions answered you have. And that's about all I have. So Steve, you can take it away and start the webinar.
All right, thank you very much, Adam. Now I'll simply just pass it to our host for today's webinar, Jeff Kisak. So, Jeff?
All right, thank you, Steve. And as has been said already, today's session is for members who are accruing defined contribution benefits in a Postmedia pension plan. If you're not sure if you're accruing defined contribution benefits, what we mean by that is the type of plan where you make contributions, Postmedia matches those contributions, and you decide how those contributions are invested. The goal being to grow your DC account balance as large as you can so that it can provide retirement income when you reach retirement. I know that a number of you on this webinar have a frozen defined benefit plan. Maybe you were earning a defined benefit pension in Postmedia's plan up till a couple of years ago. At that time, you switched over to DC format. That's fine. This webinar is for you as well. Okay. Now, if you would like to attend an in-person session, there are a number of them that are scheduled through the remainder of this month and into June, all over Ontario and in Montreal as well. So if you'd like to attend a live session, feel free to do that as well. So let's get underway here. And just right off the top, and Adam alluded to this before, if the merger is successful, and we'll talk through what that means and how what it requires for a merger vote to be successful. Both you and Postmedia will stop contributing to the P&I DC plan after June 30th and automatically start contributing to DBplus under the CAAT pension plan starting July 1st, 2019. And for those of you that have a defined benefit pension accrued under the post-defined benefit plan, that pension will, again, assuming the vote is successful, come over to CAAT. It will be replicated in and backed by the CAAT pension plan. Replicated meaning when you ultimately cease employment for termination or retirement, that Postmedia defined benefit pension that you've earned for service up to a couple of years ago will be paid to you under the same terms and conditions as you have now in the Postmedia plan. So that part won't change. Not the amount of pension you've earned, not the terms and conditions under which it will be paid to you. That will remain the same. It will just come from the CAAT pension plan instead of the Postmedia plan. And the pension you earn on and after July 1st, 2019 will obviously come from the CAAT plan as well. So with that introduction, what we're going to talk about today, I'll start by giving you all a little bit of a background on the CAAT pension plan. We'll talk about the merger process, and as Adam mentioned, the vote under the merger applies to the people with defined benefit entitlements only, and that includes those of you that have past frozen defined benefit entitlements. But for those people on the phone that only have a defined contribution entitlement, so they do not have a frozen defined benefit pension, the vote will not explicitly involve you. We'll still go through it so you can understand what it's involved, but you will not be involved in the voting process. So after we go through that, I'm going to talk about DBplus. And just to be clear, the difference between DBplus and the CAAT pension plan. Our CAAT pension plan has two pension plan designs in it. The DB Prime portion, which has been around for 50 years or so, and that was for our original plan members, and our new award-winning DBplus design, which is the one that's getting all the attention in the marketplace. And that's the one that, if the vote is successful, you will be joining. So two plan designs, DB Prime, DBplus, within the one CAAT pension plan. And again, you will be going into the DBplus plan design. So after I walk through how DBplus works, we'll go through an example to hopefully have it all make more sense. And we'll talk about an option that you have with purchasing additional pension in our plan, if you want to. It's not a requirement, but it's an available option to you. And we'll finish up with some next steps. So let's talk about the CAAT pension plan first. Our pension plan was established back in 1967 to provide pensions to Ontario's college sector. CAAT stands for Colleges of Applied Arts and Technology. So we've been around a long time, and what our members can count on is great benefit security and conditional inflation enhancements in retirement, as well as no-cost survivor benefits. And we're going to talk all about those extra provisions as we go through today. But we are definitely a defined benefit type of plan. So the type of plan that some of you will have been earning pensions under before you move to defined contribution. And under a defined benefit plan, you won't have your own individual account, and you won't have to worry about investing that individual account. Each year that you work, you will accrue an amount of pension that will be paid to you upon your retirement, or converted into a lump sum perhaps if you leave employment before retirement. But it's not the difference between this plan and the defined contribution plan you're in now. You do not have your own account. You are not responsible for investing. You don't have to worry about somehow turning an account balance into retirement income when you come to retirement. What you will build under this plan is a monthly pension that will be payable to you for your lifetime in retirement. We have a 50-50 governance model, and that means there are equal representation in our two governing bodies between employers and employees through the unions representing them. And this 50-50 governance model is recognized internationally as the optimal model for running a pension plan. When both sides of the table are involved in making decisions about the cost of the plan, the risks in the plan, you just get better decisions. We also have 50-50 cost sharing in our plan, which is why Postmedia will be matching your contributions dollar for dollar that you make into DBplus. That is the way with all employers participating in our plan. The employer and the employee contribute the same amount. We offer transparent and easy to understand communication and online estimation tools, and we'll talk about that as we go through. We also offer ongoing education sessions. Colleagues of ours from the CAAT pension plan will come out periodically and explain how the plan works again, just to keep it fresh in your mind. And we're a not-for-profit trust, which means we have low operating costs, and that means that more of your contributions and the investment earnings on them will go towards paying and securing your pensions in the future. employer pension plan. Right now we have 51 employers participating in our plan. There is another employer going through the same process at the same time as Postmedia. And if they also have a successful vote, then hopefully on July 1st, 51 employers will go to 53 employers. And we have approximately 50,000 members participating in our plan as well. The ratio of active to retirees is roughly 2 to 1. And what we want to do is make sure that our plan stays that young, vibrant, healthy plan, which is part of the reason that we are seeking to merge with other plans like Postmedia. We have a staff of about 120 people, and whether they're involved in the investments of our plan, the administration of our plan, the governance, the risk management, we're all pulling in the same direction. We are not, as I said before, we're not a for-profit company, so we're not selling newspapers or making cards. All we do with the CAAT pension plan is safeguard the pension for the benefit of our members. So all of our staff are aligned in performing that service. And it's interesting to note that no position at the CAAT pension plan, not even our CEO, gets a bonus. No positions here are bonusable. So there is no kind of incentive for anyone to act to maximize their own financial gain. Everyone's pulling in the same direction, which is safeguarding and maintaining pension security for our members. I've talked about our governance structure already. So just to give you a bit of a feel for our size, we have $10.8 billion in assets. We are currently 120% funded on our going concern funding basis, which is the most relevant one to the CAAT pension plan. And that gives us a $2.6 billion funding reserve, or excess. And our governing bodies, their number one priority is maintaining benefit security for all plan members. So as part of that, they are not focused on spending that funding reserve, but rather increasing it over the years so that benefit security becomes more and more enhanced. In terms of net rates of return, we've just released our 2018 returns, and they were slightly positive. 2018 was a tough year for all pension plans. But if we look back to 2017, we earned a net rate of return from our investment group of 15.8%. That's net of expenses, and that is outstanding. And even our 5-year average ending December 31st, 2017 was 11.4% per year. Again, very outstanding returns, and that's a credit to our investment group and their expertise. So with that as background in terms of the CAAT pension plan and the plan that you would be joining if the vote is successful, let's turn to an overview of the merger process and talk about what is required for a successful vote. So here we have a timeline, and right now we're in that kind of April to July 1st period, which is the voting/objection period. These sessions and and personalized packages were sent out at the end of March and into early April. So hopefully everyone on this webinar has received a package from us. We have websites and call centers set up. We'll talk about those a little bit later, but they're there to answer your questions. And then if the vote is successful, and we'll talk about that in just a slide or two, then active members such as yourself will join DBplus on July 1st, 2019, and concurrently you'll stop contributing to the Postmedia plans. And then shortly after July 1st, 2019, and this is when you will have already started earning benefits under our plan, we're going to apply to the pension regulators and say to them the membership has voted successfully in favor. And therefore, we are now applying to you, the regulators, for permission to transfer over the defined benefit assets and obligations from Postmedia's plans into the CAAT plan. So there's a few things in that sentence. First, and I think Adam referenced this as well with his comments off the top, what will not be involved in this asset transfer would be any funds in your DC account. The asset transfer only relates to defined benefit assets. So that's the the assets that are sitting in Postmedia's trust fund to pay the retirees their pension, to pay the folks like you who have an accrued pension under a defined benefit formula, to pay that pension when you ultimately retire or leave employment. Those are the assets that will come over with the regulator's approval. But again, it does not include an automatic transfer of your DC account balances. Those accounts are in your name, and you will be given options as to what you want to do with them, with the funds in those accounts after a successful vote. We understand that Postmedia will be winding up that DC plan, and at that time, you will be given options for your DC account balance, which will include transferring it to your own individual locked-in RRSP, transferring it to an insurance company to buy a pension, leaving the money where it is, and you'll just come out of the Postmedia defined contribution plan and have an account set up for you as an individual. And finally, another option, which we'll talk about a little bit later on, will be to use that account balance to purchase more pension in DBplus. So you will have the option what to do with your account balance following a successful vote by the defined benefit members. So let's return to the timeline here. And the regulators will take 9 months to a year to review the application to transfer over the defined benefit asset and give their approval. And at that time, that's when those assets will come over. We expect it to be around mid-2020, around July 2020. And when those assets come over, CAAT will take responsibility for paying Postmedia's existing retirees, members who are entitled to a deferred vested benefit under a defined benefit plan with Postmedia, and even your defined benefit entitlements when you ultimately cease employment or retire from Postmedia. That, instead of your pension coming from the Postmedia plan, it will be paid to you from the CAAT pension plan. And here people ask, a little bit about the security. So I will mention that Postmedia is making special contributions to the CAAT pension plan over a period of about 10 years. Those contributions are affordable to Postmedia. We've done our own due diligence on them, and Postmedia's done their due diligence on us, and come up with a 10-year schedule for contributions to be made from Postmedia to the CAAT pension plan. But let me just say, should something happen to Postmedia, a year or two into the future, at some point after the assets come over, and they are no longer able to make those special contributions to the CAAT pension plan, your pensions that you earned under the Postmedia plans will be safe and secure and paid out in their full amount from the CAAT pension plan. And why can we do that? Well, the reality is the pension payments or the contributions coming from Post, we fully expect Post to make those. Post fully expects to make them. But if for some unforeseen reason something happens and Postmedia cannot make those contributions, it's not immaterial to our almost $11 billion pension fund, and so we can guarantee you receiving 100 cents on the dollar for the pensions you've earned. And if something should happen within the transition period, so before those defined benefit assets are transferred over, something happens in the 12 months or so following July 1st, 2019, and I'm talking about something happening to Postmedia and for some reason they become insolvent, let me say first, no one expects that, and we fully expect Postmedia to be around for years into the future and make their contributions to us. But if should something happen in that transition period and Postmedia, say, goes insolvent or otherwise can't make their contributions to us, well, in that transition period, Postmedia is still responsible for their pension plan. So the regulators would step in and say it's going to be necessary to wind up these pension plans. But CAAT will, even in that transition period, CAAT will approach the regulator and say, we have an arrangement with Postmedia. We are willing to take on the obligations and pay 100 cents on the dollar. And if you will allow the defined benefit assets to transfer into our plan, and I fully suspect the regulators would say that's what we'll do. Rather than wind up the post-media pension plans and pay something less than 100 cents on the dollar, the regulators would look at that solution and say, let's allow the assets to go to CAAT, and CAAT will pay 100 cents on the dollar. So essentially, from July 1st, 2019, your defined benefit pensions that you've earned under the post-media plan and would start in the future will be safe and secure and backed by the CAAT pension plan. So with that, what is going to take to have a successful vote? Well, the requirements are kind of interesting, and they are not CAAT requirements, they're not post-media's requirements. These are the requirements under legislation. And it requires at least 2/3 of active defined benefit members or the union representing them to vote in favor of the merger. So if they don't vote, that is counted as a no vote. They must actively vote. And in Postmedia's case, the vast majority of active defined benefit members are being represented by a union. So their union will vote for them as a block. But here you see it's defined benefit members. So those that have only a defined contribution account balance and no past defined benefit pension, you will not be involved in this voting. That's because the voting refers to defined benefit assets and entitlements that have been accrued and does not involve defined contribution. So because you don't have any defined benefit entitlements, you won't be involved in the vote. So we need at least 2/3 of active defined benefit members to explicitly vote in favor. And we also need no more than 1/3 of inactive members to vote against the merger. So inactive members are retirees and surviving spouses. People we refer to as deferred pensioners, including those that are on this webinar that have a past DB benefit and you're now earning a defined contribution pension. So for purposes of this vote, you are termed an inactive member because you have a frozen and fixed defined benefit entitlement from your past service. So you are, for purposes of this vote, termed an inactive member, as well as members awaiting the payment of their commuted value, and there's a handful of those members that have terminated and have not yet received the lump sum value of the pension they had in the post-media plan. So for all those inactive members, including you, we need less than 1/3 of you to actively vote against. And if you don't vote, if you take no action, in this case, it's deemed to be in favor of the merger. So if this merger is appealing to you, you don't need to do anything. Okay? So that's what's required on the membership side. And then, of course, there's the regulatory requirement as well. And I already touched on this. Assuming we have a successful vote from you, the members of the plan, we will then apply to the superintendent of pension to get their approval to move over the defined benefit assets and liabilities from the post-media plan and into the CAAT plan. So because, for those of you, I guess, on this webinar who have a past defined benefit pension entitlement, I mentioned you are an inactive defined benefit person for purposes of this merger. At the back of your package that you received from us, you'll have a voting form. And in the middle of that last page, you'll have a box like the one shown on this slide where you can object to the proposed merger of the post-media plan and the CAAT pension plan. If you want to object, you'll check that box, sign and date the form, and return it to us. Or return it to Post, actually. And again, just at the bottom of the slide, for the merger to proceed, we require no more than 1/3 of you inactive members, and that includes pensioners as well, to vote against. And if you don't vote, if you do nothing, it counts as being in favor of the merger. So that concludes my comments for how the voting goes in the merger process. Let's move to talk about DBplus, which is the plan design that you will start earning your pension benefits under on July 1st, assuming a successful vote. So DBplus, first and foremost, is a defined benefit pension plan. And again, just to be clear, what you will earn is an amount of pension, what you will earn each year through your contributions and towards Postmedia's contributions. You will earn a pension payable at your retirement. So again, no personal account. It's not like the pension you're earning now. It is a defined benefit pension that will be payable to you for your lifetime. So you also don't have the concern that you would have in a defined contribution type of plan where you could worry about outliving your retirement savings. You do not have that concern here. The pension you will earn under DBplus will be paid to you for your lifetime in retirement. So essentially, all you have to do is make your contributions and watch your pension grow. And that's it. And for Postmedia, they just make their contributions and they don't have to worry about administering the plan, investments for the plan, oversight and governance for the plan. The CAAT pension plan takes care of all of that. So Postmedia can relax and know that they are offering a defined benefit plan to all of their employees. And the nice thing about a defined benefit plan, whether it be DBplus or any defined benefit plan, is the amount of pension payable to you at your chosen retirement date is predictable, much more predictable under a defined benefit plan than it would be under a defined contribution plan. And it is payable for your life. It has conditional enhancements, and we'll talk about more about that as we go through today. With generous early retirement benefits, you can retire under DBplus as early as age 50. There'll be an early retirement reduction applied to you to reflect the fact that you're starting your pension earlier, but you can retire as early as age 50. And we have built-in survivor benefits. We'll talk about that, but essentially the pension that you'll earn under DBplus would be continuing at 60% of the pension paid to you following your death. That pension will continue at 60% to your surviving spouse, which is a very nice feature, and we'll talk more about that as we go through. So for most members, most of you on this webinar, contributions are going to start at 3% of your earnings, and they're going to be matched dollar for dollar by Postmedia. And you can see the phase-in schedule at the bottom there. So for the first 5 years, starting July 1st, 2019, you and Postmedia will both be contributing at 3%. For the 1 year thereafter, from July 1, 2024 to June 30, 2025, your contributions will increase to 4%. And on and after July 1st, 2025, you and Postmedia will be contributing at 5%. And just like they are now, your contributions to DBplus will be tax deductible. And I'm sure Postmedia's payroll department will withhold the appropriate amount of tax from your pay to reflect the fact that contributions to our plan, just like Postmedia's plans, are tax deductible. So on this slide, we're trying to give you a feel for how your take-home pay and your weekly take-home pay will change. And recall, for the first 5 years, most of you will be contributing at the 3% range, so you're not going to see any change in your take-home pay. But then after 5 years, when we get out to 2024, your contributions will increase to 4%, and the year after that, they're going to increase to 5%. So what we're trying to show for various earnings levels down the left-hand side is how much your weekly take-home pay would decrease, just to allow you to try to budget for this, even though the first increase isn't coming until 5 years into the future. But at that time, if you look in the first row and your earnings are approximately $50,000, you could expect your take-home pay to decrease by about $7 starting in 2024, and then by another $7 starting in July 1st, 2025. If, on the other hand, your earnings are more at the higher level, we can look in the last row. If your earnings are around $100,000, you're currently your weekly take-home pay is reduced by $33. Again, that won't change for 5 years. And then when we get out to 2024, you could expect to see your weekly take-home pay decreased by about $11, and then a year later by about another $11. And these figures you see on this slide reflect the tax deductibility of the contribution. So you may have expected a bigger decrease in your take-home pay, but because these contributions are tax deductible, the increases are more in line with what you're seeing, or the decrease in your take-home pay is more in line with what you see on this slide. So with that, let's talk about how your contributions are turned into pensions under DBplus. And basically, you're going to grow your pension with two different components. The first one is based directly on the contributions that you make and that Postmedia makes on your behalf. So we're going to take those total contributions and multiply them by 8.5%, which is our annual pension factor. And that's how we turn your contributions and Postmedia's contributions into an amount of pension that you earn each year. But in addition to that, the CAAT pension plan is going to help grow your pension benefit as well. We're going to do something called an AIW enhancement. AIW stands for the average industrial wage, and it's a measure of how wages in Canada grow year over year. It's typically between 2% and 2.5%. In 2017, it was 2.7%, but it's usually between 2 and 2.5%. And what we're going to do is take the pension that you've earned under DBplus to the end of the previous year and increase that by the change in the AIW year over year. So it's kind of like getting interest on your bank account. You make contributions to your bank account, and that's the biggest way that it grows. But for those that can remember, when the banks used to give interest on our bank account, you would also be getting compounding interest in your account, which would help grow your account. It's the same type of concept here. So again, it's not an account, it's an amount of annual pension or monthly pension. So maybe an example will help bring this to light a bit further. Let's look at Philip. He's age 45. His earnings are at $65,000. And for this example, we've assumed that his earnings will increase at 2% per year. We've also assumed that the AIW would be 2.2% each year. And 2.2% is the average increase in the AIW over the last 20 years or so. Both Philip and Postmedia contributed 3% of earnings for the first 5 years, and then 4% in year 6, and 5% thereafter. So, let's have a look at how Philip's pension builds each year. I'm going to draw your attention to the top right corner of this slide. And we can see that Philip's contribution in year 1 is 3% times his earnings of $65,000, so a contribution of $1,950. Postmedia will also contribute $1,950 for a total contribution in year 1 between Philip and Postmedia of $3,900. That's the amount that we're going to multiply by 8.5%, which is our pension factor. And we get a number of $332. Let me take your eyes back over to the farthest left bar, and you can see that $332 at age 45. That's the amount of pension that Philip has earned in that first year, and it will be payable to him as an annual amount of pension when he reaches age 65. So let's look at the second year, and you can see in the dark blue box at the bottom, he earns a pension through his contributions and Postmedia's contributions of $338. The reason it's a little bit higher than the first year is because, remember, we've assumed that his earnings would increase at 2% per year. So in the second year, he earns, with a little bit higher earnings base, a pension of $338 per year, payable at age 65. We stack on top of that the pension that he'd earned at the end of the first year, that's $332. And then there's that little sliver sitting on top that says $7 of AIW. That is the AIW increase that he would get on the amount of pension he had at the end of the first year, which was $332. So if you take 2.2% of the $332, that's where the $7 of AIW increase comes from. And so by the end of the second year, if we take the $338 that he's earned from his contributions and Postmedia's contributions in that year, the $332 he'd earned to the end of the previous year, and the $7 AIW enhancement, he has a total pension of $677 at the end of the second year. Now, I grant you those AIW enhancements start small, but you're going to see they can really add up. So let's move to the third year, and through his contributions and Postmedia's contributions, he's earned a base pension of $345. Again, his earnings have increased by 2%. Stack on top of that the $677 that he earned at the end of the second year, and now it's that whole $677 that's going to attract the AIW enhancement. And so you can see it's $15 that's going to be added on by the time we get to the end of the third year. And now if we add up those three bits and pieces, by the end of the third year, he's earned an annual pension payable when he reaches age 65 of just over $1,000 per year. And you can see his pension is starting to grow. Now, I will mention these AIW enhancements that we're going to be granting along the way are conditional on the funded position of our plan remaining strong, which is why our two governing bodies, our Board of Trustees and our Sponsors Committee, are so focused on maintaining our strong funded position, because we intend to grant these AIW enhancements each and every year. But they are dependent upon the funded position of our plan. So let's extend this example out to age 65. Those first 3 years we looked at are now kind of pushed down to the far left side from 45, 46, and 47. And here we're showing Philip's pension as it grows through to age 65. The guaranteed base pension you see in the dark blue bottom triangle is the pension that he earns from his contributions and Postmedia's contributions. The AIW enhancements are shown in the slightly lighter blue that's sitting on top. And we're showing them separately so that you can see how much they accumulate over someone's working lifetime and how much additional pension they can provide. So I'll say that even though we're showing them separately, and we're doing that so you can see how they accumulate, each and every year that an AIW enhancement is granted, it forms part of the guaranteed base pension and cannot be taken away. So again, we're showing it separately throughout Philip's working lifetime from 45 to 65 so that you can see how it grows, but in reality, every year that it's granted, it would form part of that guaranteed base pension and cannot be taken away. And in this example, over the 20 years from 45 to 65, the AIW enhancements are increasing Philip's pension by almost 21%. And you wouldn't be able to see this from the graphs, but I can tell you from the analysis behind it that by the time Philip reaches age 65, both he and Postmedia would have contributed about $76,300 to DBplus. And why is that important? Because in this graph, we're now taking his working lifetime and again pushing it to the left and showing his retired lifetime and the pension payments that would be payable to him starting at age 65. And just before age 70, Philip will have recovered through pension payments to him all the contributions that he put in to DBplus for the previous 20 years. And that's why our plan has a guarantee of 5 years of payment to make sure that everybody recovers at least the contributions they put into our plan. So if somebody dies in the first 5 years of retirement, their pension would continue to a spouse, or the remaining payments of 5 years worth of payments would be converted in a lump sum and paid to their beneficiary. But that member can rest comfortably to know that at least their contributions to the plan will be returned to them through survivor pension or a payment to their beneficiary. Now, hopefully, everyone's going to recover a whole lot more than just what they put into the plan. So let's walk through this slide a bit further. Again, you can see the guaranteed lifetime pension is starting at an amount that includes the AIW enhancements. That goes back to what I said before, that once the AIW enhancement is granted, the guaranteed lifetime pension includes that amount of AIW enhancement. So that's why we have the dark blue box on the lifetime of amount of pension, starting at an amount that includes both his pension from his contributions and Postmedia's contributions, as well as the AIW enhancements that he's received along the way. Now you'll see here conditioned inflation enhancements sitting on top of that guaranteed lifetime pension. And that's because our plan also offers inflation adjustments during your retired lifetime. The inflation adjustments are equal to 3/4 of the annual change in the Consumer Price Index, or CPI. So if CPI goes up 4%, your pension would go up 3%. And just to be clear, it's your DBplus pension that you'll earn after July 1st, 2019. Your Postmedia pension will be paid to you just as you've earned it. So what we're talking about here is conditional inflation enhancements that would apply to your DBplus pension you'll earn after July 1st. And you can see by the slides that inflation enhancements are also conditional on the funded position of our plan. Again, that's why our two governing bodies focus so much of their attention on maintaining our high funded status. But they can also, you can see these inflation adjusted enhancements can really increase the amount of pension over your retired lifetime. We're showing here someone who retires at age 65, their pension payments out to age 90 when we would assume they would pass away. And that's a reasonable expectation of life for someone retiring at age 65. And you can see that his pension has gone from maybe a little over the $16,000 to up over $24,000 25 years later with those conditional inflation enhancements. So they can really make a difference over your retired lifetime. Can you imagine being on fixed income for 25 years? That would be an onerous thing for sure. And in this example, and I'm looking now at the box in the top right corner, total pension payments expected to be made to Philip over his retired lifetime are actually 755% of the contributions he remitted to DBplus. So that's a very good return. And the other thing to notice here is the survivor pension on the far right. Remember I talked before about a 60% survivor pension being paid to your surviving spouse if you have one. Well, in this example, Philip does have a spouse and is survived by that spouse, and the spousal pension starts at 60% of what his pension had grown to at the time of his death. So you can see just by eyeballing that survivor pension starts at 60% of what his pension had grown to with the conditional inflation enhancement. You can also notice that the survivor pension is also sloping upwards. Now we've only shown a couple of years here, but the reality is that survivor pension would be paid for the lifetime of the surviving spouse and would also attract conditional inflation enhancement. That's why you see it sloping up. So there are a number of things that are conditional on the funded position of our plan. The AIW enhancements during your working lifetime and the inflation enhancements during your retired lifetime. So a natural question is, just how likely are these enhancements going to be? And I will tell you that we first introduced conditional inflation adjustments back in 2007 and have not missed a year yet. And that includes 2008 when the economy went very south. We also have our external actuaries perform projections and asset liability studies for us, and they project our funded position out 20 years. And they look at different economic scenarios, including repeating 2008. And those studies tell us that 99% of the time we'll be in surplus when we get out 20 years. So that gives us very good comfort that these conditional enhancements, the AIW during your working lifetime and the inflation enhancements in retired lifetime, are very, very likely to be granted. But say there's a year where the funded position of our plan turns downward a bit, decreases a bit, and we can't, our governing bodies decide we don't really want to fund or provide an enhancement for this year. Well, our plan has a catch-up provision so that when our plan returns to that strong funded position, any enhancement that hadn't been granted along the way will be made whole and will be caught up. So you can take comfort in that as well. or that you can retire as early as age 50 in our plan. But if you retire before age 65, your DBplus pension will be reduced to reflect the fact you're starting it earlier, and therefore it's likely to be paid for a longer period of time. The reduction for your DBplus pension would be anywhere from 3% to 5% for each year that your retirement age precedes age 65. Currently, it's at 3%, and it's also based on the funded position of our plan. So 3% is the smallest reduction that we will apply, and of course, the smaller the reduction, the more pension that you'll receive in retirement. So you want that small early retirement reduction. In this case, if you're retiring at age 60, that's 5 years before age 65, and at 3% per year, the pension you've earned to age 60 would be reduced by 15%, 3% times 5 years, to reflect the fact that you're starting your pension early. Now, some people look at that as a penalty for early retiring, but it's actually a subsidy. Because if we were to actuarially or statistically reduce your pension the right amount to reflect the longer period of payment, it's more like a 6% reduction that should be applied, a 6% reduction per year. So if you wanted to retire at age 60, that's 5 years times 6%. The actuarial tables would say reduce that pension by 30%, and we're only going to apply a 15% reduction. And also notice that the Canada Pension Plan, which allows you to start your CPP pension as early as age 60, but they apply a reduction per year of 7.2%. So under the CPP, if you wanted to start your CPP pension at age 60, you'd be subject to a 36% reduction. And that early retirement reduction is applied only once at the time of your retirement. So depending on the funded status, if the reduction would be anywhere from 3% to 5%, we fully expect it will remain at its lowest level of 3%. But of course, cannot guarantee that. It depends on the funded level of our plan. But the point is, it is only applied once at the time of your pension commencement. And then once you have your reduced amount of pension, off you go and retire, receive your pension, and it would receive the inflation adjustments on that lower amount. Other provisions under our plan, we have death benefits payable, and the benefit is dependent upon when you die. If you die before you start your pension or after you start your pension. So let's look at the situation where you die before you start your pension. Again, we're going to split that into the scenario where you have a spouse and where you don't have a spouse. And spouse here is under the provincial definition of spouse, so includes common law spouses and same-sex spouses. If you die before your pension commences and you have a spouse, your spouse is entitled to a lump sum payment. It's the lump sum commuted value of the pension that you had earned to your date of death. And again, I'm only talking about your DBplus pension that you will earn after January 1st, 2019. The pre-retirement death benefits for your Postmedia pension, as well as the early retirement reduction we just talked about that would be applied to your Postmedia pension, would be the ones that are currently provided for under the Postmedia plan. So essentially, we would look at your pension as two parts, your Postmedia part, and apply any early retirement reduction under that plan, under the current rules that apply to the Postmedia pension. And then we look at the DBplus pension you earned after July 1st, 2019, and apply early retirement provisions, or if we're looking at death benefits, apply the DBplus death benefit, and then add the two together to get your total benefit. Okay, so that's an important thing to keep in mind, that your pension, your total pension between your Postmedia and your DBplus pension will be looked at separately. Your Postmedia pension will be reduced, or if we're talking about death benefits, the Postmedia death benefits would apply. Same thing for your DBplus pension. It would be the DBplus early retirement reduction or DBplus death benefit, and then we would add the two together to get the total pension or benefit payable. So let's return to pre-retirement death benefits where you have a spouse. Again, if you're dying before your pension commenced and you have a spouse, the benefit payable to your spouse is the lump sum commuted value. That's what we do as actuaries. We take a series of pension payments and convert it into a lump sum, or we can take a lump sum and convert it back into a series of pension payments. So if your spouse does not want that lump sum, he or she doesn't want the headache of investing it and managing it through their future, they can receive, instead of receiving that lump sum, they can have either an immediate or deferred pension payable for their lifetime, with a minimum payment, again, of 60 monthly payments. If they want the lump sum, they can have it transferred from the CAAT plan to an RSP on a tax-sheltered basis, or they can take it as taxable cash and pay some tax on it and have the spendable money. And if they don't want that lump sum, again, they have the option of an immediate or deferred pension. So what about where you die before retirement but do not have a spouse? Well, that situation is on the right side of this slide. And again, the benefit is a lump sum, but now it will be paid to your designated beneficiary, which is why it's very important to designate a beneficiary, even if you have a spouse, because let's say your spouse predeceases you and you don't update your pension forms. If you don't have a designated beneficiary at the time of your death, the benefits will be paid to your estate. So it's very important to designate the beneficiary, even if you have a spouse. Okay? So the death benefit payable is the lump sum commuted value, same lump sum commuted value that's payable to your spouse, but here it's payable to your designated beneficiary. But before we pay out that lump sum to your designated beneficiary, we're going to look and see if you have any children under the age of 18. And if you do, we have a children's survivor pension that's payable until they reach age 18 in the amount of 50% of the pension that you had earned to your date of death. If you have only one child, that child will receive 50% of your pension until they reach age 18. Let's say you have two children, they're going to split that 50% equally between them. And as they age, when the older one reaches age 18, that survivor pension would cease, and the full amount, the full 50%, would be paid to the younger child until they reach age 18. And it's the same whether you have 2, 3, 4, or more children under the age of 18. The pension is allocated equally among them, and then as each child reaches the age of 18, the survivor pension is reallocated among the younger children. And what will ultimately be paid to your designated beneficiary is the lump sum commuted value of your pension, less whatever we've paid to your eligible children. So now let's look at the scenario where you die after your pension has commenced. And again, we'll look at the with a spouse and without a spouse scenario. If you started your pension and you passed away and you were survived by your spouse, then, and we've talked about this already, 60% of the pension that you were receiving at the time of your death will continue to your spouse for his or her lifetime. And it will be adjusted for conditional inflation adjustments during their lifetime. If you feel that 60% isn't quite sufficient, then at the time of your retirement, and it has to be at the time of your retirement, you can increase that survivor percentage up to 75%. That's the one option that we offer. So a little bit higher percent continuing to your surviving spouse after your death. But if you take that option, the pension that you received initially and for your lifetime would be slightly reduced to reflect the fact that a larger pension is going to continue to your surviving spouse. And the reduction that would be applied to your pension would be determined by the actuarial tables, but it would be about 3%. On the death of your spouse, on the subsequent death of your spouse, the pension would continue to any eligible children that you and your spouse have that are under the age of 18. If you do not have a spouse, you've retired, you started your pension, and have passed away, but do not have a spouse, here 60% of your pension would be paid to your eligible children under the age of 18. Just as I explained it in the pre-retirement death scenario. But under both of these, there is a guarantee of 60 monthly pension payments, whether they go to you your surviving spouse, your eligible children, or your beneficiary, there is the guarantee that someone will receive 60 monthly pension payments of your initial pension amount. Okay? And one last thing on death benefits, we have a very nice provision. And if you are married at the time of retirement, but your spouse predeceases you, and then you meet someone else and that person becomes your spouse, then upon your death, if you are survived by that second spouse, they would be entitled to a continuing survivor spousal pension for their lifetime as well. So it's a very nice feature that, and it's fairly unique to our plan as well. So we've talked about death benefits. What about if you just leave employment before you start your pension? Well, in that case, you'd have two options. First, you could take a deferred pension option in our plan. So that means you cease employment with Postmedia, but you leave your pension, your DBplus pension, and your Postmedia pension in our plan. If you do that, then the goal would be to at some point in the future after you've reached age 50, commence your pension. If you take this route, then we will grow your DBplus pension through from the period from your date of termination of employment through to your date of pension commencement. And we're not going to grow it with AIW, but we will grow it with 3/4 of the change in CPI. So your pension just doesn't sit as a frozen amount of pension. Your DBplus pension will grow from your date of termination to your date of pension commencement at whatever age you want to start it after age 50. And we're going to grow it each year conditionally on the funded position of our plan at the same increase that retirees would get on their pension. Now, if you choose this route and you want to retire before age 65, you may certainly do that. You can retire as early as age 50. But because you're retiring from a terminated employment status as opposed to an active employment status, the early retirement reduction that will be applied to your pension will be 5% per year for each year before age 65 that your pension quits. So you recall a few slides ago we talked about a 3% per year reduction. That's for people retiring from active employment and going straight to pension commencement. If you have terminated your employment before age 50, but want to start your pension early sometime after age 50, it will be subject to that 5% per year reduction. You will also have the lump sum option where you can transfer out the lump sum commuted value of your pension. And again, it's the same lump sum commuted value that we talked about for the death benefits payable to your spouse or beneficiary. So you can transfer out the lump sum commuted value out of our plan. In that case, you are responsible for investing it. You will not have any further entitlements under the CAAT plan. You will be responsible for investing it. And in order to have that option, you must terminate employment before retirement eligibility. And that means age 50 in our plan. So you have to terminate your employment before age 50 because once you are retirement eligible, you lose that lump sum option. And you would have to take your pension as a deferred or immediate pension. Again, you'll lose that lump sum option after reaching age 50. But there's also an extra wrinkle. We have what we call a 2-year extension of membership in our plan. And remember, we're a multi-employer plan, so if you cease employment with Postmedia, we want to make sure that your employment relationship truly has been severed, and that you're not going to start working for another employer, another one of the 51 employers that are participating in our plan. Because if you do that, your DBplus pension will just continue to grow with that employer. by waiting 2 years before we'll pay out the lump sum value to you. And if that 2-year waiting period, if that 2-year extension of membership period takes you past age 50, then you will not have the lump sum option. You will not be able to transfer out the lump sum commuted value. So, in effect, you have to terminate your employment before age 48 to have this lump sum option. Okay? This graph is just to help people who are in defined contributions or saving for retirement on their own to see just how much bigger the bank can be for each dollar they're contributing. Now, this is not a study done by the CAAT pension plan. This was a study done for the HOOP plan, the Healthcare of Ontario pension plan. And it was done by a third party for them. And basically, it says for every dollar that you're contributing to your retirement, if you are doing so as an individual contributing in your RRSP, based on the assumptions that this study had, you could expect to receive back $1.70. If you are participating in a large DC plan like Postmedia's, you could expect to receive back $2.58 for every dollar you put in. And that's because there's more rigor around contributions. You're contributing probably on a mandatory basis. You're getting access to some investments that you wouldn't have as an individual, and you're probably getting lower fees charged by the financial institution. So that's why it's going up versus an individual. But if you come to a defined benefit, a modern defined benefit plan like CAAT is offering, that amount almost doubles to $5.32 for every dollar you're putting in. And that's because we get all the advantages of a DC plan, but we can also pool risks. We can pool investment risks. And we're not investing as individuals, we're investing for our plan in aggregate. We can pool mortality risks. Some people will die earlier, some people will die later, and so we don't have to think about each individual. We can look at the group in aggregate. And when you do that, and you also have access to the investments that we have, members can expect a much better payback for each dollar they put in. So that's just a little bit of background information on defined benefit plans like CAAT versus saving on your own in an individual or defined contribution sort of plan. So now I want to talk about the option to purchase additional pension. And we won't spend too long on this because it is just an option. We're not at July 1st yet, so we're not sure that the vote will be successful. But if it is successful, we'll come back in the future and talk to you folks about purchasing additional pension. It won't be for everybody. Some people would like to have funds left in their own RRSP, and that's fine. I absolutely understand that. Some people, on the other hand, would prefer to change that money in their RRSP so they don't have to worry about investing it. They don't have to worry about the fees that they're paying the financial institution. And they don't have to worry about how are they going to convert that account balance into retirement income. Instead, they can basically exchange their RRSP account balance for a guaranteed monthly income for life. So let's just talk a little bit about that. You can purchase additional pension under DBplus, and you have to purchase additional pension in respect of periods of employment. So the first one is a period of employment with Postmedia as a participating employer, assuming the vote is successful, that are not already credited under the CAAT pension plan. So that means that any period of service you have that has a defined benefit pension associated with it, you may not purchase additional pension in respect of that period of service. And that's because you already have a defined benefit pension associated with that period of service. But for other periods of service where you were earning a defined contribution type of benefit, like I think everyone has on this call for at least the last couple of years, you would be able to purchase additional DBplus pension in respect of that period of service. So, in a nutshell, it's any period of service with Postmedia for which you do not already have a defined benefit pension. And we can even go back to employers before Postmedia, provided that you are that employer's formal registered pension plan. So not in their group RSP or savings plan or anything like that. It had to be periods of employment with that former employer where you were participating in their registered pension plan. If you want to purchase additional pension, the funds to purchase that pension must come from a registered tax-sheltered vehicle. And certainly your your account balances in your DC plan at Postmedia would certainly qualify. But where we can't do is take funds from your regular bank account or any after-tax investments. The money must come from a registered tax-sheltered vehicle. And that's because it's a transfer from one tax-sheltered vehicle, your Postmedia DC plan or your own individual RRSP if you wish, or a combination of both, into another registered tax-sheltered vehicle, the CAAT pension plan. So it's a tax-sheltered transfer, and that's why the funds have to come out of something that is already a registered tax-sheltered vehicle. There are limits to how much you can transfer in. So first, let's talk about the limits on how much you can transfer in, and then we'll talk about how we turn any amount you may wish to transfer in into additional pension that would be credited to you and paid to you when ultimately you retire. So first, on the limits that transfer in, and this is not a CAAT limit and this is not a Postmedia limit, this is the limit under the Income Tax Act. The amount you can transfer in is limited to 18% of your total earnings for the period for which you wish to buy additional pension. That's why we have to talk about a period of service, because we're going to look at the total employment earnings that you have, and these are gross T4 earnings that you had for that period of service, multiplied by 18%, and that gives the maximum amount that you can transfer in. So if we go back to our example from Philip, and let's just assume that he started employment with Postmedia on January 1st, 2014, and was never participating in defined benefit pension at Postmedia. So if we go back 5 years, and we've just made up some earnings amounts there for those 5 years, and we have a total of those earnings for that 5-year period of $315,000. So the maximum amount that Philip can transfer in and buy additional pension under our plan is 18% of that $315,000, which in this case is $56,700. Now, it's going to be different for everyone on this call. The period will be from when you moved to a DC plan up until July 1st, 2019, the earnings that you have in that period, or if you were not earning a defined benefit ever, it could go back to your date of hire. It just cannot include any periods of service where you have a defined benefit entitlement with the Postmedia pension plan. And in this case, we can see that the maximum amount that Philip could transfer is $56,700. Now, this is not a one-time thing. It's not a temporary window. He can transfer amounts up to $56,700 at any time. We're going to see in just a second that if this is an attractive option for you, the sooner you do it, the bigger the bang for your buck. But just to be clear, this is not a one-time thing. It's not a temporary thing. You can do this transaction at any time. And you can spread it over 2, 3, 4, however many transactions you want, provided the total amount transferred from your registered vehicle, your RSP, or your Postmedia DC account balance does not exceed the maximum amount that applies to you. So just to say that again, if you spread this over a number of transactions, the sum of the amounts transferred must be less than the maximum amount that applies in your situation. So, how do we turn an amount transferred into the CAAT pension plan into an amount of pension that will be payable to you in the future? Well, it's the product of A times B times C, where A is the amount you're transferring in, fairly straightforward. B is that DBplus pension factor that we talked about before, the 8.5%. And C is a purchase adjustment factor. And to your normal retirement date, which is age 65. And the reason that we have this factor is for those that are transferring in money closer to age 65, we're not going to have the amount that they transferred in for a longer period to invest it and have it grow and pay for the pension we want to pay them. So we have the purchase adjustment factor to reflect basically how close you are to your normal retirement age. If you are age 40 and below, the purchase adjustment factor is set at 100%, so no impact. Above age 40 and up to age 65, it decreases by 1.4% per year. And again, that's to reflect the fact that we're not going to have the assets you transfer for as long a period as we would for a younger person to invest it and provide the pension that you're purchasing. So let's see how some examples here. We've got 3 different individuals here. They are age 40, age 50, and age 60 on the left side. All 3 want to transfer in $40,000. The DBplus pension factor is 8.5% for each of them. And now we get to the purchase adjustment factor. For the first person, because he's age 40 or younger, it's 100%. For the second person who's age 50, that's 10 years past age 40, and I mentioned that the purchase adjustment factor decreases by 1.4% per year. So at age 50, that's a 14% reduction, and so this purchase adjustment factor is 86%. And the final person at age 60 has a 72% purchase adjustment factor, and that's because they're purchasing additional pension closer to the date that it's actually going to start. So in the next column, we have the credit amount of pension at the time of purchase. And it's just the product of the 3 previous columns. So for the first, for the age 40 person, it's 40,000 times 8.5 times 100%, 3,400 of annual pension payable at age 65. For the age 50, it's less. It's 2,924. That's because they are closer to the retirement date. And finally, in the last row, it's 2,448. Now, that's the amount that's initially credited at the time of purchase, which is at their age. But just like your regular DBplus pension grows with AIW enhancement, so does any additional amount of pension you wish to purchase. So for the 40-year-old, he's initially credited with $3,400, but over the 25 years to age 65, and again we've assumed AIW at 2.2%, that annual pension has grown to $5,858 starting at age 65. And I say starting at age 65 because just like your regular DBplus pension, any pension you purchase will also attract the post-retirement inflation adjustment, 3/4 of the change in the CPI each year. Again, conditional on the funded position of our plan. But if we continue that example out to the first row, we can see that if this person retires at age 65 and lives to age 90, they could expect to receive $176,000 in change in pension payout for that one $40,000 transfer. Of course, they would also receive the DBplus pension they earned over those 25 years. This example just isolates the additional pension purchased by this person. So that's a return of more than 4 to 1 on his initial contribution. And even if we jump down to the bottom row, the 60-year-old could expect to receive $82,000 in total pension payments in retirement. So if these people die earlier, they'll receive less. But if they die later, they'll receive more. Again, age 90 is a reasonable average expectation of life. So even for the 60-year-old, where he's getting back $82,000 on an initial transfer of $40,000, is seeing a very solid return on his transfer. And as I say, we will come out, assuming a successful vote, and talk to you more about purchasing additional pension under our plan. And I will just reiterate, it's an option. You are under no obligation or requirement to purchase additional pension. And I can certainly understand that it won't be for everyone. So, as we come down the home stretch here, we'll talk about next steps. Please visit website that we have set up for you at www.dbplus.ca/PNI. Please don't forget the /PNI because that is the microsite that has an estimator set up for you folks with your contribution starting at 3% or 4% or 5%. So don't forget the /PNI because we want you to go on and play around with that estimator, see how much your DBplus pension can be as you earn pension in the future on and after July 1st, 2019. And of course, I mentioned we'll come back and talk to you about purchasing additional pension. This slide is just to give you a glimpse as to what the estimator looks like, but I encourage you to go on to the website, again, /PNI, and try out that pension estimator. There are different sources of information as well. There is a toll-free number, the 1-866-350-2228. And if you'd like to email questions to us and get an email reply, so you've got something in writing, you can email your questions to postmedia@dbplus.ca. So finally, in closing, just some key messages. DBplus, because it's a defined benefit type of plan, offers a predictable pension. You can see your pension grow through your working life and estimate what it would be at different retirement ages between 50 and 65 to help you plan for your retirement. And it's a secure lifetime pension backed by the CAAT pension plan and our exceptionally well-funded plan that it is. It has a high probability, as we talked about that before. The external studies that we have done suggest a 99% probability of being fully funded 20 years from now. Those conditional inflation enhancements, which will be so valuable through your retired life as we live longer and longer in retirement these days. A built-in survivor pension at no additional cost to you, 60% of your pension continuing to your surviving spouse, whether you're married at retirement or take a spouse after retirement. Starting as early as age 50, and again, just to reiterate, that for those that have a Postmedia defined benefit pension already, it will be transferred to the CAAT pension plan along with the assets that back it, assuming a successful vote, and fully replicated under the terms and provisions that you've earned it under the Postmedia plan. So again, when we're looking at your total pension at some point in the future, we'll look at your Postmedia part and apply any provisions and early retirement reductions if you're retiring early. Then we'll look at your DBplus part and look at the early retirement provisions and any other things that apply, and then add the two together to give you your total pension that will be paid from our plan.
All right, thank you, Jeff. I believe that's it for questions. There were quite a few, and thank you for all those who participated. And just
so just as I lose my voice, good timing.
Yeah, and just as a reminder, if there's something that we didn't address today, or if you want to send a personal question in, please don't hesitate. Send it into our email address. It's showing on the screen there. You can see it postmedia@dbplus.ca, or you can give us a call at our contact center at 1-866-350-2228. So I'll just turn it back over to Jeff to close out the webinar.
Well, I'll just echo Steve's comments. Thank you very much for your attention today. I know there's a lot of information here. It's going to take some soak-in time. I do believe this is an excellent opportunity for all Postmedia employees to either start earning or recommence earning a defined benefit entitlement. Hopefully you've seen the great value that DBplus can provide you with the conditional enhancements and retirement and working life and the early retirement and survivor benefits. So let it soak in, and if you have questions, come to one of the other in